Hey, what's going on, guys? Dan over here, and wanted to bring you some breaking news. So today, Monday, September 16th, the Liberal government came out and dropped a little bit of a bombshell as far as housing affordability, particularly around insured mortgages. And I wanted to share those details with you. If you haven't already heard, there are some changes. And if you are in the market for a property and you were considering a default insured mortgage, this is for you. So, what are we going to do with these changes? Well, first off, the changes are to come into effect December 15th, and this is fluid. Things are changing, and as more details come out, I'll definitely make sure to let you guys know. But let me just share my screen over here. You can see over here, this is coming from Ottawa. So Ottawa is saying they're going to expand the insured mortgage, default insured mortgages to 30 years. So 30-year amortization along with higher caps on this. This is going to improve affordability on a few different fronts, and I wanted to jump into it and kind of show you guys what I mean. So let's get into it here. So first-time home buyers as well as those purchasing new builds. So earlier this year, we had a change to insured mortgages, and I called it. I thought there was going to be a change coming that would affect all insured mortgages. But prior to this, it was an extension of the amortization to 30 years if it was a new build. Now, the federal government has come out and said, you know what, we're going to put this across the board, and we're going to allow these changes to happen for anyone that's buying as a first-time home buyer and needing a mortgage. So prior to these changes, it says right here, the Liberals are raising the price cap for taking out insured mortgages to $1.5 million. That's up from $1 million. Prior to this, and if you're living in a large city, $1 million doesn't really give you too much house these days. And with the average being, especially in the GTA, over $1 million, that prices most people out. And prior to this, if you were interested in a house that was $1 million or more, you got to come up with at least 20% down. That's called a conventional or an uninsured mortgage. Now, there was a benefit there. One being that if you did hit that 20% down, we could extend the amortization to 30 years, which leads me to my next point. They are extending that amortization to 30 years for insured mortgages. Really important here because one, we can increase that cap to $1.5 million, and we can extend those payments out to 30 years. So that's going to help with our qualifying criteria. If you guys recall, the mortgage qualifying rate, or that stress test, up until now is 2% higher than the actual interest rate you get on your mortgage. And right now, those interest rates, you know what? I'm just going to take you on a little magical journey where we go to a place that a lot of shoppers will go. It's called Rate Hub. And I'm just doing this real time, guys. Let's say we're getting a mortgage right now. Right, and it's insured, and you're putting less than 20% down. These are generally, now keep in mind there's some teaser rates here, but just to kind of give you an idea, 5-year is going to be your lowest, and let's just say, I'm going to say compare all rates. Okay, then you get a whole list here of different rates. Now, let's say you really wanted to work with quote unquote Canadian lender. Could be anyone, could be no one, but let's say 4.09%. And I've heard as low as 3.99 in the market, but let's just say 4.09. That's the price or the interest rate you are going to get. Well, the stress test states that your interest rate or the qualifying rate is 2% higher. That is now 6.09%. And if we had to cap you on a 25-year amortization, it doesn't go as far as 30 years. And in fact, the insured rates are lower than conventional uninsured rates as well as rental rates. So this is really important because this is going to help stretch the affordability as we do it over 30 years. So that's some big time changes here. One on the maximum purchase price cap of $1.5 million. And to kind of give you an idea, as far as I know right now, anything over $500,000 up until $1 million, you got to put 10% down. So it's a sliding scale, right? Now that sliding scale is going up to $1.5 million. If we can assume the same 10% down in anything over $1 million, that's an extra $50,000. So If I'm doing my math right, $125,000 versus $200,000 for a minimum down payment. That's not too bad. Now, as far as what you have to pay for premiums by putting the minimum down, that's yet to be seen. We'll keep an eye on the CMHC website as well as Canada Guarantee and Sagen to get an idea of where this is going. But guys, I just wanted to kind of drop that news for you. It's good. It's and I guess the question is, where are rates going to go, and where's the market going to go as we kind of round out the year? Well, with this news coming out, I could anticipate as interest rates continue to come down, there's going to be a little bit more pressure on the buy side. So we may see more people out in the spring because more people are able to qualify, and especially in that north of $1 million market, you might see a little bit more action. But again, I do not have a crystal ball. That's just my best guess. Okay, guys, hope you're having a great day, and I will talk to y'all soon. Take care.